Price volatility is often seen as the biggest risk in digital asset markets. Sharp price swings grab attention, influence sentiment, and drive short-term decisions. But for institutional investors, price volatility is only one layer of a much deeper risk landscape. Real risk goes beyond what you see on the chart. In digital markets, factors like governance stability, infrastructure reliability, and liquidity resilience play a critical role in determining whether capital can be deployed, managed, and protected effectively. Focusing only on price can hide structural weaknesses that only become visible under stress. Governance is one of the most important layers. It defines how decisions are made, how conflicts are handled, and how systems respond during uncertainty. If governance is unclear or inconsistent, even stable markets can carry hidden risk. Strong governance ensures predictability, alignment, and long-term stability. Then comes infrastructure. Trading platforms, custody systems, and settlement processes must perform reliably, especially during high volatility. Even if prices seem stable, failed transactions, delays, or system outages can create serious execution risks. For institutions, reliable infrastructure is not optional. It determines whether markets are investable at scale. Liquidity is another critical factor. It's not just about volume, it's about depth and consistency. A market may appear liquid under normal conditions, but during stress, liquidity can disappear quickly. When that happens, spreads widen, execution becomes difficult, and risk increases. True liquidity resilience is measured by how markets behave under pressure, and everything is interconnected. Digital asset markets rely on shared infrastructure and overlapping systems. Stress in one protocol can spread across others. Collateral linkages, cross-platform dependencies, and shared participants create a network where risk can cascade quickly. On top of that, behavior amplifies these risks. Herd mentality, short-term incentives, and feedback loops can turn small issues into major disruptions. Price volatility is often just the visible outcome, while the real risk lies beneath. That's why institutional risk evaluation goes deeper. It integrates governance, infrastructure, liquidity, systemic connections, and behavior into one structured framework. Because in digital markets, risk isn't isolated, it's layered. At Kenson Investments, this multi-layered approach helps align capital with markets where execution is reliable and risks are measurable. If you want to move beyond price-based decisions and build a strategy grounded in real market structure, visit kensoninvestments.com and connect with the team today.